today at a time when there is considerable speculation that we find ourselves in the late stages of a global economic expansion and that a period of unbridled globalization has peaked. As policymakers grapple with this new environment, one in which the relationship between inflation and unemployment seems to have changed, there is no shortage of important questions. Are we in a new phase of the global trading system? How are trade tensions affecting the health of capital markets? Do policymakers have the requisite tools to effect change? Fortunately, we have a terrific panel this morning to take up these and other issues. I am pleased to turn the floor over to the moderator of our first panel, The Word from Wall Street. Brendon Greeley is U.S. economics editor with the Financial Times. Brendon?
I'm going to let them sit down while I talk. I'm a little flustered this morning. I was supposed to come in last night. I ended up getting on a train at 5 o'clock this morning in Baltimore because I had to stay in Washington because they inconveniently scheduled an impeachment for last night. Pretty much ruined everybody's plans. I'm not a congressional reporter, so I got to call presidential historians. That was a lot of fun. But something else happened last week in Washington which overshadowed the Fed meeting. Well, it didn't happen in Washington. It happened in New York. All of us who cover the Fed went into the Fed meeting, and all we wanted to know about was what the New York Fed and what the FOMC were going to do about the spike in the repo price. And if that is a confusing sentence to you, we can talk afterwards. But short-term interest rates got out of control for a variety of reasons that we're not going to belabor right now. We ended up talking about that. We ended up writing about that. What we missed was an opportunity to talk about a very interesting time. It is a murky time. I use the word murky because that's what Jay Powell said in his last open communication before the Fed meeting, and I think it's still appropriate. It's very difficult to figure out where we are, as you said, in the cycle. It's very difficult to figure out how some things that we had assumed about economics are changing. So I thought we'd start. I'm going to give everybody a chance to introduce themselves, but we're also going to play a game that I hope is as fun for you as it is for me, called If I Were Jay Powell. Let's pretend that what happened in the short-term interest markets last week didn't happen. That's a mechanical problem that has to do with the plumbing of what the Fed uses to affect policy. How would you describe the state of where we are right now, had you been giving that presser last Wednesday?
My name is Michael Hanson. I'm a senior global economist at J.P. Morgan. And so I take a more of a global perspective. And so I think the background here is relevant in that the things that are moving Fed policy right now are largely not the normal things you would plug into some sort of reaction function for the Federal Reserve, right? The unemployment rate is very low. The inflation rate is not that far from target, and there's obviously some concern about it being low, but I don't think that's what's motivating Fed policy right now. I think it really is a question around the risks, particularly global risks. And in that regard, I think that the Fed has done largely the right thing, which is to highlight that these risks are out there and that policy is going to take a more of a risk management or an insurance approach to try to make sure that they do the best they can to cushion those risks. I don't think they can completely offset those risks, and I'm sure we'll talk a fair bit about kind of trade policy and what it means. And obviously, the interest rate is not the ideal tool to try to counter what's happening on the trade front, and Chair Powell said as much. I think from a broader global perspective, the concerns right now, as was laid out of the opening comments, we're seeing signs the global economy is bending. It has not yet broken, and policymakers are stepping in to try to make sure that it doesn't as best they can. To that point, the Fed has a lot more firepower in reserve, although it is still fairly limited relative to history, than quite a large number of other central banks do. This has led a number of policymakers to suggest that maybe fiscal policy should step in the breach. We'll talk a little bit about that as well. There's some questions about the efficacy there, of course, in addition. And so what we have is a period really of heightened uncertainty with a lot of risk skewed to the downside. And so in that environment, I think the right thing for Chair Powell and for the Fed is to sound cautious, to say that, look, we're on top of this. We recognize the U.S. economy is doing relatively well, but these things can spill over onto U.S. shores. It used to be the case that when the U.S. sneezed, everybody else caught a cold, but now we're a little more susceptible. And in that sense, I think he did largely the right thing in that regard, which is to keep the door open, to try to cushion those blows, recognizing that we are not at this point apparently on the verge of recession in the U.S., given what we see in the data.
Greg, if you were Jay Powell.
Yep. So good morning. I'm Greg Daco. I'm Chief U.S. Economist at Oxford Economics. I think this is a great intro in terms of the backdrop that the Fed is facing from a global perspective. If we look at some of the domestic fundamentals, they're actually quite good. Jay Powell and a number of Fed participants have mentioned that the U.S. economy is in a good place right now, that if you look at labor market indicators, we're in an economy that is still growing at a fairly strong pace. We've added more than 2 million jobs every year for the past 8 years. We're still adding job at a pace of about 175,000 jobs every month. We have an unemployment rate that's at a 60-year low. We have wage growth that's stabilized above 3%. And very importantly for U.S. consumers, we have real disposable income growth that is trending just below 3%. And that is supportive of consumer spending growth around 2.5%, which is quite decent. The thing that I think is important to keep in mind when you're looking at the U.S. economy and when you're looking at it from a Fed's perspective is what's ahead. What's coming in the next 6 months, in the next 12 months. And we know for sure a few things. We know that domestically, momentum has passed its inflection point. So if you look back at the last 18 months, we've had an economy that's essentially been, that accelerated through early 2018 and had an inflection point in mid-2018 and has been slowing since then. That's a factor of a couple of things. It's a factor of the global headwinds that we're seeing, the fact that global growth has slowed. It's a factor of stemming from the fact that we've seen an increase in trade tensions vis-a-vis the U.S. and China, but also Europe and other trading partners. And it's also a function of an economy that is coming off of a fairly large fiscal stimulus. Granted, the fiscal stimulus did not have as large of an impact as was touted to be the case initially by the administration, but it did stimulate growth, and we're coming off of that. So you have global headwinds and slower domestic momentum. And in that environment, the Fed has to provide for a cushion, insurance easing, as Michael was highlighting, in terms of preventing a sharper slowdown in the economy. Now, in terms of what I would have said or what I would have done coming out of the policy meeting, I think it's very important to remember that there isn't a unified voice within the Fed right now. You have very different perspectives amongst the different participants and even amongst the voters at the Fed. Some would favor further accommodation, other would actually favor the status quo. So coming out of these types of meetings, when there are very intense discussions as to the future of policy, it's very hard and very hard for Powell, but very easy for us to understand that it's very hard to come out with a unified message. And I think that is why we're seeing, and we saw over the past few meetings, Jay Powell really struggle to provide a unified voice, a consensual voice, because there isn't right now a consensual voice within the FOMC.
Abby.
Hi, I'm Abby Joseph Cohen, Senior Investment Strategist at Goldman Sachs. And before I answer the question, I just want to tip my hat to my fellow panelists. Michael and Greg have given you so much information packed in that I'm very impressed, and I find myself in agreement with what they've said. So I'm going to answer the question somewhat differently, and that is, if I were Jay Powell, right now, I would be taking a very deep breath, or many very deep breaths, because the chair of the Federal Reserve Board has been put into an extremely difficult position. Now, there are a couple of us on this panel who are former economists at the Federal Reserve. So we've seen the process in action, and we know that it is a fact-based process. The hundreds of PhD economists at the Fed, I think the current number is 452, basically spend a lot of time analyzing all the data, US and global, what is happening, running very sophisticated models in terms of trying to determine, at least in a probabilistic way, what's likely to happen. And the reason I would be taking a very deep breath if I were Jay Powell is that the risk of exogenous factors, to use that statistical term, is extremely high. And one important source of that exogenous factor that's so hard to forecast is that it's coming from the White House. It's coming from the White House in various forms. It's coming from the White House in terms of the jawboning. The president constantly tweeting with regard to what Jay Powell and the other members of the FOMC are doing and what they should be doing. This is something that infringes, in my view, on the independence of the Federal Reserve. The idea of a central bank, and this is true in most developed countries, is that the central bank is supposed to act independently of the political system. And so I think that this is a source of exogenous risk. The second is trade policy. We're going to spend more time on trade, so I'll just say the following. If I take a look at a chart of volatility in markets, both fixed income and equity, we see that that volatility has spiked from time to time over the last 2 to 3 years. Each time it has been related to a presidential tweet. I'll say no more on that particular topic.
Okay, good. You're not going to leave me with that.
Okay.
Good.
And then finally, on fiscal policy, we can spend more time on this important issue as well. But in the United States, we've kind of used up a lot of our dry powder with regard to fiscal policy. The tax cut that was implemented did dramatic damage, in my view, to the budget balance of the United States, i.e. the deficit has increased notably. And it's okay for the deficit to increase if, in fact, you get something for it. The verdict is out. It's still a little soon, but the early data suggest that the fiscal policy that has been implemented thus far gave us a temporary sugar high in terms of a bump up in GDP, but what many had hoped for, which would be a longer-term increase in GDP growth, hasn't materialized, nor has there been a step up in capital spending, i.e. long-term investment by corporations. So we've had a very significant reduction in corporate tax rates, which has not led to much of anything. I'm happy to spend much more time on that, but this is supposed to be the introduction. So I'll say one more thing, and that is there is some evidence that there were some sporadic improvements in terms of consumer spending as a consequence of the tax cuts. But here again, we have to wait and see whether this is a long-term phenomenon.
One thing you said cut to the very core of me, which is that if you cover the Fed as a journalist, the one thing that you cannot do, because it will ruin your coverage, but is deep in your heart, is that you want to talk to the Fed economists, all 352 of them. 452. And you want to have them think you're smart. It's very painful as you ask stupid questions. I want to pick up on this idea of fiscal spending because we didn't just spend through the tax code over the last 2 years. We also spent outright by releasing the sequester limits. I think hiding sort of underneath the news of the tax cut was a release in sort of a crimp that we had put on federal spending, and you can see it in the GDP data over the course of the last 2 years, and we just did it again. So economists always complain that they don't get to run experiments, and we actually just ran an experiment, which is, can you add both through the tax code and outright fiscal stimulus at high capacity and not create inflation? And we did that. I mean, that was, I think, interesting to a lot of people. So I'd like to talk about some of the things that we're learning right now, because it does seem like the things that we understand about economics are changing. Let me throw this to Greg. It also seems like one of the things that the Fed has been realizing is that as we add this stimulus, as we add stimulus at capacity, we're bringing people into the labor force who wouldn't have otherwise been there. We're forcing businesses to look for people who have a drug history, who have a criminal record, and figure out ways to get them back into the workforce. That was a surprise to a lot of people that we could have that beneficial effect. What are the things do you think we're learning as we run stimulus at capacity?
So I think the first thing we learned over the past couple of years, I would say, is that we're perhaps not at capacity. That the capacity that we thought we were at was not the actual real one. Now, to use an economic term, economists often refer to NERU, which is the non-accelerating inflation unemployment rate. Non-accelerating inflation rate of unemployment. So essentially, it's what is considered the natural rate of unemployment, at which point everybody that is employable is being employed. And over the past few years, what you've seen is that the labor market, being as hot as it is, was able to pull in more people from the sidelines. And some people that perhaps were initially viewed as not having the appropriate skills or not having the right types of backgrounds did re-enter the labor force. I usually point to a very interesting statistics when it comes to the labor market, in that if you look at the labor participation rate, so the amount of people that are working, that are employable essentially, that are working, if you look at that data point, you see that essentially it's been flatlining over the past 3 to 4 years. That hides two very distinct forces. On the one hand, you have upward cyclical forces that are essentially reflective of this labor market that continues to attract people into the labor force. But at the same time, you have a very strong structural drag. With the US population aging, you have more and more baby boomers retiring. And those two forces are offsetting. To me, that points to a labor market that's actually not at capacity, but that is still bringing in more people from the sidelines. So that's the first thing I would note. The second thing I would note is that the inflation trade-off, so the trade-off between unemployment and wage growth has shifted over the past 3 to 4 decades. It's less powerful than it was, but it's still present. If you look at the wage growth dynamics over the past few years, there has been an acceleration as the number of unemployed individuals has diminished. As labor market slack has fallen, you've seen a gradual acceleration in wage growth. Now we're stabilizing just above 3%, but you have to keep in mind that at the same time as this is happening in terms of still bringing people into the labor force, you have a number of headwinds that we've all discussed. And those headwinds are international in nature and domestic in nature. And if businesses, which are the key here, if businesses are uncertain about the future, they're more likely to be cautious about hiring, and they're more likely to be cautious about their costs. And what do you have affecting costs at the same time? Tariffs. So if you have an environment in which your input costs are rising and you're a business decision maker, then you have to think about how you're going to pass on those costs. And the key question here for businesses is, am I able to pass on these higher input costs to the final consumer? And if you look at a wide array of data, you'll see that actually the pricing power element to this question is really key. Businesses don't have as much pricing power as they might have had in a similar economic situation back in, say, the early 2000s. So if your pricing power is more reduced, you're more likely to be cautious when it comes to your input costs. And if you have tremendous uncertainty regarding the trade tensions, regarding the policy outlook, you're going to be much more cautious. I think that those are two important factors to highlight when it comes to the labor market dynamics.
And please jump in.
Yeah, if I may, with regard to the labor market, one of the things that's so critical to long-term economic growth is growth in the labor force. And if you look at the developed countries, and I include China in this because it may not be a developed financial market system yet, but it's certainly a developed economy, even though it likes to think of itself as an emerging economy. The fastest growing labor force has been that of the United States. And it helps explain why, one reason why, that our economy has had better long-term economic growth. Here is a very important fact for you. Half of that growth has come through immigration. As we cut back on immigration, there will be implications for long-term economic growth. And if I go back to my PhD studies, 60 to 65% of the people studying in the United States for advanced degrees in engineering and applied science are in fact foreign-born. So as we cut back, because we're reducing legal immigration at this point, I don't think it gets enough attention, quite frankly, but we've cut back in terms of the number of visas we give for people coming to study in the United States or people who have specialty occupational skills. All of that has gone down notably over the last 2 to 3 years, and that's something that could affect long-term economic growth. Now, while you process that, let me add something which is sort of like an inside baseball comment, and that is maybe we don't know what the capacity is of the United States. Years ago, when I was at the Fed, the group that I worked with was looking at those capacity data and the utilization data, and what we basically know is that when an economy transforms, when it goes, for example, from heavy metal bending industry to more sophisticated industry and so on, the data don't keep up. Because what happens when capacity utilization data are calculated is they're looking at the percentage importance, the weight of various sectors and subsectors in the economy. If those weightings have in reality changed, what happens is you tend to overweight industries that may not be as important as they used to be, and you are underweighting, or in some cases ignoring, companies and industries that are growing in importance. And I believe that this is something that may be happening. Why is that? Because the Fed is dependent upon something that's done by the Census Bureau, which is part of the Commerce Department, in which they do what's called a census of manufacturers, or a census of companies out there. How much are they actually producing? And one of the things that has happened in recent years is that we are not funding these kinds of data studies. Now, I know this is sort of an inside baseball comment, but if the economists don't have the data they need to know where we are, it's very difficult for them to do these calculations properly. It affects capacity. It affects our measures of inflation and any number of other things, including our metrics for productivity in the economy.
The simplest way to think about how to create economic growth, and this is highly simplified, is that it's a function that involves the size of your labor force, the productivity of that labor force, so how efficient you can make them work, and then the amount of capital that's available to invest in new things. I would argue in the U.S., to exactly to your point, we're really, really good at encouraging capital to get off the sidelines. We've got a variety of policies with bipartisan support that will do that. We tend to take the labor force for granted. One of the things that's been interesting for me, 3 years ago, I did a profile of a guy who had lost his job at a factory and ended up getting trained to be an HVAC repairman. The federal government paid for his training. It was part of a very small program called Trade Adjustment Assistance, but it was a small success story, right? He had a new career in HVAC, and we walked through the transition. A couple of weeks ago in my hometown, I saw a sign planted in the grass by the side of the road. It just read, "Wanted, HVAC repair, will train." So one thing that happens when you run this economy at capacity is that businesses are willing to do training that they wouldn't have considered paying for even 2 or 3 years ago. But let's pick up this idea of trade uncertainty, because a year ago there was great uncertainty about trade uncertainty, right? We knew that businesses would have a certain reaction when they didn't know what was going on with trade. We didn't know what that reaction would be. There's been a ton of research from the Fed and elsewhere about sort of what that is. So, Michael, can you walk us through sort of what we are more certain about now, about the actual real physical consequences of trade uncertainty?
Yeah, I would argue we're pretty certain that we're very uncertain, right? That there's still quite a lot of uncertainty impact on business decisions, on corporate and consumer sentiment, and certainly on the markets, right? And I think that's really the main implication right now of the ongoing, trade negotiations, trade dispute, trade war, however you want to characterize it, not just between the U.S. and China, but more broadly. There's uncertainty about ratification of the replacement of NAFTA. There's uncertainty about U.S. trade relations with Europe, with Japan, and so on, right? And so I think this really fundamentally works not through direct channels you might think of breaking supply chains, which no doubt is out there, and you certainly see clear evidence that, for example, CapEx spending has slowed dramatically around the globe. We do a lot of top-down work in our shop of trying to get global aggregates, and you clearly see that CapEx spending globally has slowed quite dramatically. This has happened along with seeing, for example, margins of firms globally shrink quite dramatically, to your earlier point on pricing power. And so you're already in an environment where you clearly don't see the kind of investment, not just in the US, but globally, in countries that aren't directly impacted. You would see, I think, an even stronger story right now in Germany and in Japan, even though they are not the direct targets or the direct participants in US-China trade negotiations. Okay? And I think this is largely a reflection not so much of the tariffs themselves, but of the uncertainty the tariffs create fundamentally about what does the global, formerly rules-based trading regime look like in a 2, 5, 10, or 20-year horizon. And if you're going to be making capital spending on those sorts of horizons, and you don't know what that's going to look like and how that's going to spill back into your costs, into your supply chains, ultimately into the desired capital structure, you're going to tend to sit on your hands. And that's what we're clearly seeing some evidence of. What's interesting is we have not yet seen it spill over into other sectors of the economy. So the labor market in the US and globally, consumer spending, consumer confidence, at this point have acted like fire breaks to that significant global shock to corporate spending. And I think right now we're kind of on the precipice. Does it look like that is going to spill over? Or does it look like those fire breaks in combination with a pretty sizable shift in policy? If you go back 6 or 12 months ago, I mean, everyone was expecting central banks to be tightening policy, and everyone expects they're going to be easing. Everyone thought that we were, outside the US, probably done with fiscal expansion. Now we've got China and possibly discussions in Germany and certainly a number of other Asian economies expanding their fiscal policy support. There's a real tug of war between those fire breaks in policy on the one hand and this persistent latent uncertainty shock, largely coming through, but not completely limited trade policy on the other.
I think to your point about trade uncertainty, you mentioned NAFTA. I think it's important to make sure that we properly weight which uncertainties are having the largest effects. I talked to the CEO of a manufacturing company a couple of weeks ago, and I said, "How's business?" And she said, "Tax cuts have been great. Business is booming." I said, "Are you worried about China?" And she said, "Not really. We get some of our supplies from there." And then she said, "Look, you're in Washington. Can you please make sure they pass the new NAFTA?" That seems to be a much bigger deal for American manufacturers, and I think I'm part of the bias where we focus on the day-to-day in the China trade war, and in fact, in terms of business investment, USMCA may be more important. Abby, jump in.
If I may, we do something like 40% of our trade with our North American neighbors, right? And we have a surplus. In much of this, we look at the goods numbers, but if you add in our service trade, which is very substantial, we've got a surplus with our neighbors. One of the problems, I think, is that the discussion on trade policy, yes, focused on China, but also focused on deficit, and deficit is not necessarily the issue. Because if you have supply chains, you in fact could be looking like you have a deficit, but it's U.S. companies importing from other countries. That is much of the issue with a deficit with China. And by the way, I think it's fascinating that both of you have referred to this new agreement as NAFTA, because the reality is it's tweaks to NAFTA, right? It's not really a big new agreement. The Clinton administration took it on the chin from their supporters in the Democratic Party by pushing this through. And so to have opened up the Pandora's box, again, may not have been so clever. The other Pandora's box that was opened that I think will prove to be an enormous blunder was the U.S. withdrawing from the Trans-Pacific Partnership. The TPP was not pro-China. It was protection against China, not just for the United States, but for all of the other nations who have borders or coasts on the Pacific. It actually took care of some of the issues that the new NAFTA is supposed to take care of, because both Mexico and Canada are part of the TPP. So some of the things the United States wanted in terms of labor protections, environmental protections, and so on, were all part of the TPP. And then by withdrawing, U.S. withdrawal from the TPP, what we're basically seeing is that China is picking up very dramatically its own trading relationships with those countries who previously were going to be part of this U.S. trading bloc. It was I'll use the word again, it was a blunder.
Yeah, two quick comments on that, if I may, to follow up. I mean, the first is the USMCA, the new NAFTA. Two things to note. One is it's America first. It's the USMCA. And secondly, the words free trade do not appear in the name of the agreement. I think that's telling, right? To pick up on your other points, I mean, I think it's very important to recognize, too, that the administration has single-handedly moved the U.S. away from a multilateral approach. This is why you don't see the backing for TPP. Now, this was kind of underway before the Trump administration came in. There's a lot of reticence amongst Democrats to move forward with TPP as well, despite the support from the Obama administration. But regardless, I think that the real uncertainty on a forward basis is, have we permanently broken, or have we at least really kind of run asunder for some period of time a multilateral rules-based framework for international trade or not? And so even if it turns out that President Trump does not have a second term, open question obviously at this point, what kind of damage has already been done, I think really is an open question, and that feeds back into the uncertainty we had talked about.
I think something, though, to keep in mind about the politics of all of this is that I don't think that policymakers were prepared for how wrenching and awful the transition was to bringing China into the global economy over the first decade of the 2000s. And I don't think that there was a response prepared for that, and the response didn't really come until 2016. And so I think it's true, we can all sit on this stage and agree that we're better off in aggregate if we have good, solid trade relationships with all of our major trading partners. But I think part of that, and that's something that this administration recognized but has failed to act on, is being prepared to respond to what happens domestically when you enter in the free trade agreements. That's waiting. That response hasn't happened yet.
Yeah, but I'm sorry, go ahead. Just very quickly, I think Brian is exactly right. The United States was the main sponsor years ago for the Chinese to get into the World Trade Organization. And then the question becomes, and what do you do after that? And I think one of the mistakes made by many people is, as I mentioned before, the trade on the arithmetic, the focus on the arithmetic of trade deficit, because of supply chain complications. I think the real issue are the ones that have been talked about in Washington now for many years, and that is the forced movement into ventures in China, where a foreign company can be only 49%, the control stays with a Chinese company, the forced technology transfers as another example, the theft of intellectual property, and so on. And interestingly, there were papers prepared in 2015 which addressed all of this, was brought to the attention of both campaigns. And there was a reception on the part of the people who are economic advisors, both parties, to these underlying issues. And then I think what has happened is we've kind of reverted to this simplistic discussion of deficit as opposed to some of the other things. And by the way, in this task force that was working in 2015, Mr. Lighthizer, who was the president's main trade negotiator, was part of that. So he knows full well the extent of these issues, but the political process seems to be overtaking.
I mean, I think one thing that we can definitively say is that no matter who's in office, in 2 years, our trading relationships are going to be changed with our partners. Let me try and take this and move it forward. We've talked about sort of the consequences of all this uncertainty and what they have on business investment. That's something that's very real and that we can measure. And where it's put us is arguably in a manufacturing recession. Not definitely. You could look at a bunch of different indicators, but you could make a good faith case that we are. Let me throw it to Greg. is it possible that we could go through a manufacturing recession over the course of the next year and that consumers could be fine?
Yes, the answer is yes, in a simple way. If you look back at the last 4 years, back in 2015, 2016, we had a manufacturing sector that was undergoing quite a significant amount of stress. And yes, yet the U.S. economy did not enter a recession. It did slow, but it did not enter a recession. The manufacturing sector today represents about 10% of the U.S. economy, much less than in other economies, even advanced economies like Germany. Germany right now is seeing the significant downward pressures on its manufacturing sector spilling over to the rest of its economy. And that's why it's likely to enter at least a technical recession in the third quarter of this year. In the U.S., we have some insulation in the fact that the share of the manufacturing sector is less pronounced. That being said, that does not mean that there will not and have not been spillovers onto the services sector of the economy. And the main channel through which that works, one of them we've talked about, is confidence, but the other one is employment. If you have an environment in which businesses are less certain about the outlook, then they're more likely to hold back on hiring. And just to put some numbers and perspective on the trade tensions around the world, one of the things that we look at when we evaluate the impact of trade tensions between the U.S. and China is the direct effect of trade tensions. And the tariffs that were imposed prior to September 1st on half of our imports from China imposed a drag, according to our estimates, of about 0.3 on U.S. GDP. That's not much. Even for an economy that's growing at a 2.5% pace, 2% pace, that's not a huge drag on the economy. The key question, though, is how does uncertainty affect the economy? And one of the topics that we've been all discussing is this rise in uncertainty. I actually think it's very hard to capture how much the uncertainty is affecting business decisions. There are different ways to do it. There's an economic policy uncertainty index that was developed. There's a trade policy uncertainty index. There's volatility in the financial markets. There are private sector confidence readings, but it's very hard to capture how large that is. We did a recent paper where we looked at how much uncertainty had increased over the past 18 months. Initially, when you had tariffs on washing machines and solar panel cells representing about $8 billion of trade, not much. But recently, with the threats coming on consumer goods, with the threats of new tariffs on consumer goods, with the uncertainty as to what the administration would do, which is a point you very rightly made, that uncertainty, that volatility, that spillover to financial markets has increased. And when we look at the future tariffs, the potential tariffs, so the increase of tariffs on the existing $250 billion that we import from China to 30% on October 15th, the potential implementation of tariffs on major consumer goods in December, those tariffs could range anywhere, the impact from those tariffs could range anywhere from 1/10 up to 6/10, depending on the uncertainty response. So I think we have to keep in mind that when you ask about how the manufacturing sector can influence the rest of the economy, one of the key channels is confidence. If business confidence starts to deteriorate, if consumer confidence starts to fall, which we haven't seen to a greater extent yet, that will lead to less spending, less investment, and that will spill over into the broader economy and could push us closer to a recessionary environment.
Yeah, and I just want to underline how hard it is to measure uncertainty, right? We're still in very early days and sort of figuring out how it is that you get a measure of what trade uncertainty is. You can use indicators that are developed that look at press mentions, that look at earnings calls from corporations. This came up in a sort of press scrum with Jim Bullard of the St. Louis Fed, where he was looking at trade uncertainty and sort of using indicators, and I asked him, what happens if it gets even more uncertain? And he looked at me like I was a 5-year-old, and he said, look, it was low, now it's high. So that's what we know right now. That's as sophisticated as it gets. But let me throw this to Michael. One of the things that we all seem to take for granted on the stage is that there will be no fiscal policy to address a downturn if there is one. And I think that we all agree enough on that it may not even be worth wasting time on it.
So I'm going to disagree.
You're going to, please, all right, do that.
So much like there are no atheists in a foxhole, there are no fiscal conservatives in a recession, right? So when the recession hits, we are going to have fiscal stimulus. That is not, I think, the question. The question is the efficacy. The question is what impact is it going to have. The question is how much firepower is out there. right? We're in a very low interest rate environment. In fact, in a number of countries, we have negative interest rates. This is one of the reasons why you have a range of economists and monetary policymakers from Mario Draghi on down and others calling for a range of governments to try to take the mantle a bit, to try to give some support to the broader economy, because it really is quite cheap. And the irony here is we're going to be running a little global version of M&T Light to some extent, as governments really push out their debt limits to try to see just what the impact of that's.
We doing MMT this morning?
No, we're not. So much like the Holy Roman Empire, according to historians, was not particularly holy, wasn't really Roman, and it was not an empire, so it is that modern monetary theory is definitely not modern. It really harkens back to things around the World War II area. It's tangentially monetary, because it's really about fiscal policy. And those of us trained of economists have a hard time viewing it as a theory, since it's not really internally consistent. But that's all I want to say on that point.
But the way to talk about it, I mean, the easiest way the easiest argument to make that's sort of consonant with what you're saying is that it may be that governments have more room to spend than we had thought.
Yeah, I think it's fair, right? I mean, the issue is we don't really know what the consequences are going to be, right? So I think what we've learned, certainly I would argue, if not over the last 10 or the last 20 years, is the bond vigilantes are either extinct or in very deep hibernation, right? So the traditional reasons you would get worried about deficits picking up, having this adverse market reaction that would cause your bond yields to spike, the reason why the Clinton administration was so incentivized in the 90s to get to a surplus situation is not very relevant, it seems, today.
Yeah, I think the interest rate environment is essentially key. And for the U.S., I've always thought that fiscal space was a useless concept, to be honest. When you have the reserve currency of the world, that is your currency, when you have U.S. treasuries that are considered safe haven assets, I don't think that implementing any type of fiscal stimulus at a time when the economy is slowing to try to generate growth, which was your point, as long as it has a positive effect on growth, I really don't see fiscal space as being a restraint, and I think it's a misguided concept. The question, though, is when this occurs. I think we had a very interesting experiment, to your point, that we had a fiscal stimulus put forward at a time when the economy was actually doing relatively well. We were growing at about 2% before the Tax Cuts and Jobs Act and before the Bipartisan Budget Act. Now, we increased growth to about 3% temporarily. It didn't really have a big effect on the supply side of the economy, especially in light of the immigration constraints, the tariffs, which are weighing on potential supply. But there wasn't really a need for additional fiscal stimulus at that point. If push comes to shove, and if we enter an environment of reduced growth, potentially contraction in economic activity, I don't think fiscal space is really going to be a concern, especially not for policymakers today.
Let me actually throw one last question, just sort of on that. I spend a lot of time listening to monetary policymakers, and they always say the same thing, which is, could you please, please, please do some fiscal policy so we aren't doing everything? And I'm empathetic to that. I understand that they've been begging for it for a while and it hasn't been coming. At the same time, I often feel like this is a terrible reference, like I'm watching the movie Clerks. Not getting a lot of sense of the room that anybody's seen it. But one premise of the movie is that all sorts of things go wrong at a convenience store, and one of the workers in the convenience store over the course of the movie keeps saying, "I'm not even supposed to be working today, man." And so at what point do you get to go back to central bankers and say, "I'm sorry you're not supposed to be doing this, but you're going to have to"?
Is that for me?
Yes. We can talk about Clerks.
I'd love to talk about movies. By the way, I saw the Downton Abbey movie. Fabulous. If you want something really calming, that's the movie you should see. So with regard to this very important question, what would I do? I'll start with my answer from before, and that is, first I would take a very deep breath. Because not just the Fed, but central bankers around the world find themselves in this very awkward position where we're not quite sure how various pieces of policy fit together anymore. I would say that as a market strategist, so let me step out from the economics for a while. As a market strategist, I am nervous, particularly about the fixed income market. When I take a look at credit spreads, the difference between the yield being paid by a good credit versus a bad credit, those spreads have narrowed to the point that was where Alan Greenspan was talking about irrational exuberance. By the way, remember the irrational exuberance speech? Everybody said he's talking about the stock market. Almost all of that speech was about fixed income markets, right? So we take a look now, the credit spreads are extremely narrow. You take a look at the duration spreads, short money versus long money. Those spreads are extremely narrow. What that's basically saying is there's incredible demand for fixed income. Our valuation work says it's mispriced. Now, it's been mispriced for a while. Valuation models are not timing devices. So when I think about, can this persist, I find more concerns on the bad side of the ledger than the good side of the ledger. We've already discussed the good side of the ledger, right? Economies are slowing a little bit. Inflation is low. We probably have more capacity available, and so on. But when I take a look at what some of the surprises could be on the negative side, and surprises by their nature really can't be forecasted, but here are some possible surprises. Number one, MMT. It doesn't really work, right? The argument is you can have very large fiscal policy deficits because you're paying for it in your own currency. That's kind of the Reader's Digest expression of MMT. Well, I take a look at what's happening in terms of demand for treasuries. Here's some factoids for you. For years, roughly 90% of the trade occurring within Asia was occurring in US dollars. And only 10 to 20% of that trade was with us. Okay, so all of these other nations in Asia are using the dollar, the world's reserve currency. They're not so much anymore. Okay, since the U.S. withdrawal from the Trans-Pacific Partnership, and as China is building its relationships within Asia, a lot of those contracts are being done in renminbi. They're not being done in dollars. So that's another concern about MMT. So when I take a look at the valuation of credits right now within the fixed income market, there's no margin for error. I like to see big spreads because then if something goes wrong, you say, okay, I'm kind of protected. But there's really no protection. So if there's an unpleasant surprise, there's really no place to hide. What happened in the repo market a week or two ago, that may have been specific to the repo market, may have been specific relative to the financing that banks now have to do under regulatory requirements and so on. But it basically said that once things start moving in the wrong direction, you're not really sure how big that spike is going to be and how long that spike is going to last. So I would basically say that while I don't disagree with the baseline forecast of inflation just modestly increases and interest rates kind of stay under control, and that gives us all kinds of flexibility on the policy side, where I see the risks are maybe we're being too complacent. Maybe we get volatility spikes, maybe we get interest rate spikes. Now, we are at extremely low interest rates. So we go from extremely low to a little bit less low. And maybe that does not afflict the real economy because capital costs for people buying houses or cars and so on don't increase very much, but we get back to the uncertainty phenomenon that we've all discussed. And we try to measure uncertainty as well, and we are finding that things are not all that comfortable. One more comment, if I may. We know that corporate cash flow has increased notably. One of the reasons is that corporations are still doing okay, margins coming under some pressure, but they're still pretty good. Returns on equity still pretty high. The tax cut led to more cash coming into corporations. What are they using the money for? If we take a look at how the money is being used, a few years ago, 75% of corporate cash was being used for things like capital spending and M&A, strategic M&A, building the businesses. That 75 for the S&P 500 is now 50%. 50% is going into share repurchases and increased dividends. Now, on a short-term basis, that's great for shareholders. On a long-term basis, what does that say about what the companies think their growth, long-term growth prospects are.
Yeah.
And I find that concerning.
Yeah, there's been this argument for the last year now about stock buybacks, and the defense is always there's nothing inherently wrong with it. It just moves capital around efficiently. My thought is always that there's also nothing inherently wrong with tequila, but if you find that you're taking 10 shots in a night, it may be a cry for help. It may be an indicator that something's going wrong. I'm going to ask somebody who's actually in charge whether do we still have time for some audience questions, or do we need to wrap it up? We have 5 minutes. Okay, why don't we take 2 questions? I'll come down and give you the mic.
Hi. Another source of uncertainty is the potential for an inverted yield curve. And one of the factors that's contributing to that is the decline in the long-term interest rates. Despite the fact that we're seeing that on U.S. government spending, revenues have stayed pretty constant. Government spending has stayed relatively constant. We're seeing a huge surge in social spending as the aging baby boomers are now paying out Social Security, Medicare, Medicaid. So despite these deficits, the interest rates are falling. Why is that? Does that represent that there's a tremendous appetite for debt? And if so, does that mean that we could be spending more money on infrastructure?
Shall I start? Basically, my answer is let's take a look at this in a global context. A fairly substantial portion of U.S. securities, Treasury securities, are owned by non-Americans. And they are focusing in a world where, yes, this is the world's reserve currency, so there's demand for the dollar because of trade, number one. Number two, with negative interest rates around in other places, even a 1.5% yield looks pretty attractive. And then from a portfolio management standpoint, I hear the argument that worries me the most, which is TINA. We all know what TINA is. There is no alternative. And like other people on this panel, I spend a lot of time speaking to people who manage large portfolios, sovereign wealth funds, pension plans, endowments, and so on. And this is the time of year, beginning in September, when everybody is reviewing their asset allocation. And I have to say that when I hear, as I have heard, so many of these thoughtful people saying, Tina, there is no alternative, I have to own U.S. credit, I have to own U.S. fixed income, and despite the fact that the credit spreads are so narrow and so on, that makes me nervous.
You've said a couple things on the stage that link to your question that I think are relevant for your earlier question about monetary policy, which is we clearly have low interest rates around the world. You've given a nice summary of a number of reasons why, right? I think part of it comes down to there's this clear demand for safe assets. This may be a post-crisis phenomenon. We also, of course, had central banks step in with large-scale asset purchases designed and I would argue largely successful in bringing down term premia, which also helped bring down interest rates. It's a point where around the world, not just short interest rates, but long interest rates are very low or negative. So back to the question of, well, central bankers, this is their job, even if they think that they're not on the clock right now. What are they supposed to do? The transmission mechanism for monetary policy is through low interest rates. Interest rates are already low. Corporations are not investing. Both the tax cut and monetary policy was designed to reduce the cost of capital. That is not the constraint. That is not why businesses are not investing. So the efficacy of the tools, I think, is the much more important question. We could debate whether they have all sorts of other things they could buy, although in the U.S. they really can't, right? But you could argue, you could go in 1,000 different directions in monetary policy, but in the end, you're pushing on a string of already low or negative interest rates. You're not going to have that much of an effect, quite frankly. And that's where potentially fiscal policy can step in. And to the extent that markets are not concerned about elevated debt levels at this point, that's what gives some scope for fiscal policy. I think that's why you're hearing those calls right now.
Thank you. So I'm Sarwar Kashmiri, fellow of the Foreign Policy Association. My question for the panelists is, if you were to pick the two biggest risks of investing in the U.S. and the EU and China, what might they be?
Why don't we start with Greg in the middle, and then we'll wrap this up, and everybody will get a chance to answer.
Well, I think certainly one of the things we have alluded to in these last few comments is the risk on the financial market side of things. If you look at asset prices across the board, I think there are areas of concern, and we have to be watchful of conditions in which spreads are extremely compressed, especially in an environment in the U.S. where you have corporate debt that is rising and the quality of that debt deteriorating. I would note to Michael's point earlier that even though monetary policy may not be as efficient as it once was because of low interest rates, there is an asymmetry of risks from the monetary policy side of things. And that asymmetry has to do with financial conditions. One of the other transmission channels of monetary policy beyond interest rates is financial conditions. If the Fed does not provide accommodation, the risk is that financial conditions tighten. A stronger dollar, depressed stock prices, rising volatility. That can have significant negative effects on the economy, as we saw in the fourth quarter of last year. To me, that's a major concern, not just for the U.S., but for the rest of the world. A tightening of financial conditions at this juncture would be quite significant in terms of its impact on the real economy, on spending, and on investment. And that is something to pay very close attention to going into 2020.
When I think about the interrelationships of countries, this is where my biggest concerns are. If we go back 10 years to the global financial crisis, one of the things that made it less bad was international coordination. And in fact, that international coordination began here at the UNGA meetings at that point. People then moved down to G7, turned out to be G20 meetings in Washington, and they discussed ways in which they would come together to kind of calm things down. And I, for one, was quite impressed by the job they did. Obviously, it was a very serious situation for financial markets and the underlying economies. I think it could have been a lot worse. And you specifically mentioned China, so let's talk about China. I already discussed ways in which the Chinese have not been playing, shall we say, fairly. But let's talk about what they did do in the aftermath of the financial crisis. They were not directly affected by it because their banks didn't make as many of the same mistakes as the banks in the U.S. and Europe had made. And they were in a unique position to actually help the rest of the world. And I think that when we talk about Chinese currency manipulation, I have to say it brings a smile to my face because during this period of time, over the last decade or so, the Chinese did not manipulate their currency down. They manipulated it up, right? It was like one of the most stable currencies relative to the dollar and to the others. And so most recently, there's been some movement in the RMB downward, but the Chinese actually were good global citizens during the aftermath of the GFC. So back to your question, what am I worried about? I think the risk is that with the damage that's been done to multilateral relationships and organizations over the last few years, this is something that presents a risk to the global economy. The structure that was built after the Second World War, both with regard to foreign policy and also with regard to the global economy, I see that those protections have been negatively affected, in my view. Did they need to be altered and modernized? Absolutely. But you don't, in my view, you don't tear down the house before you have the new structure in place.
It just in terms of kind of framing your question as sort of an investor, right? Presumably the things you care about are your risk-adjusted real return. So if we run through that very quickly, to Abby's earlier point about there is no alternative, it's not clear investors are being appropriately compensated for or are taking risks in a way they're being appropriately compensated for. So there's a lot of tail risks in the global economy out there that could really, I think, undermine some of the positions that people are taking in terms of where they're putting their money right now. I think secondly, in terms of the real part of the return, again, you alluded to some of the potential upside risks on inflation. I'm personally much less concerned about that. If I had to pick my poison, I am more worried about deflation given the limited tools we have on a forward basis than I am about inflation. But it is a risk.
Inflation would be a high-class problem.
Fair. And then simply in terms of the return, I mean, the reality is, and we kind of skirt around the issue, the thing that I imagine is on many people's mind in the audience right now is when is this recession finally going to roll around? And in that environment, of course, you're looking at the possibility of very low returns. And it's against the backdrop of some of the other things we talked about from a broader perspective in which I would argue a large number of Americans in particular in the baby boom generation are not prepared for the possibility of lower average returns in going forward than they might have seen or expected earlier in their lives.
Yeah, that's a fantastic list of things to be terrified about.
Card-carrying member of the dismal science.
With that, I unfortunately have to go return to writing a deep dive on the ample reserve regime, the Federal Reserve. And if anybody has any thoughts on that, speak now or forever hold your peace. I got to publish it tomorrow morning. I want to thank everybody on the panel, Abby Joseph Cohen, Greg Daco, and Michael Hanson.
Thank you.